Over the last year, I have made multiple videos talking about how to measure balance sheet KPIs and financial ratios. And in today's video, I wanted to put it all together in one place, in one video, so you can watch this video and come out of it feeling confident, not only in your ability to calculate these financial ratios, but more importantly, your ability to interpret them and read them and explain them, for example, to management if they ask you, what does debt to equity ratio means, for example. So in this video here, you're gonna watch and you're gonna see how to calculate these ratios and then how to read them and interpret them. And if you've been watching my channel, you know that I always put a huge emphasis for accountants and financial analysts to be well-versed and understand financial KPIs and financial metrics, because reading financial information on its own, like looking at a balance sheet, can be extremely boring, while looking at a KPI in terms of a percentage or a ratio can be more exciting and also easier to digest. And as always, if you want to go deeper into learning these KPIs and financial metrics, if you're an accountant or a financial analyst, I'll leave a link to my online courses down in the description below. And with that said, let's jump into today's video. And first, we'll begin by looking at the liquidity ratios. Hey guys, today I'm going to teach you 3 financial ratios or metrics that are used by financial analysts and investors to look at a balance sheet and assess whether the company has enough liquid assets to meet its short-term liabilities. And so when you look at a basic structure of a balance sheet, and we'll walk through it here in a minute, you can either look at it and say that the company has $100,000 in cash, which is a very simple number and doesn't tell you much of what's going on in terms of current liabilities, or you can use these financial ratios such as quick ratio, current ratio, and days sales outstanding to give a more complete picture of the company's position in terms of liquid assets. And if you're new here, welcome. My name is Bill Hanna. I'm the financial controller. I've been in the finance game for the last 15 years, and I'm a licensed CPA in the great state of New York. And this channel is all about giving you the summary of my 15 years of experience. And what we do here is we comment on fraud cases, we talk about stock investment and finance career advice. So if you're in finance or a financial professional, or in general just curious about learning more about finance, and make sure you subscribe to the channel so that you don't miss out on any of the videos that I put out on a weekly basis. And without further ado, let's dive right into today's topic. So the goal of these liquidity ratios is to figure out whether the company has on its balance sheet enough liquid assets here on the current asset side to meet its short-term liabilities or current liabilities. And first, before we jump into these financial ratios, let's walk through the basic structure of the balance sheet. And obviously it's called the balance sheet because the asset side needs to balance or equal the liabilities and shareholders equity side. So as you can see here, the total assets in this case is $450,000, and the total liabilities and shareholders equity is also $450,000. And so the basic accounting equation, and let's put it up here so that we remember it, is that assets will equal liabilities plus equity. And if you remember from the days of learning math, if you take then the liabilities here on this side, so assets minus liabilities equals equity. And the concept here is very similar to when you own a house. So if you own a house and the fair value of the house is a certain dollar amount, and you have a loan on that house, that's the liability here. So when you subtract the liability out from the value of the home, then what's left over is the equity, or your equity in that home. And that's the same concept here with a company. When you have liabilities, if you pay off all of your liabilities using your assets, what's going to be left over is your shareholders equity. And that's the basic concept of the balancing of the balance sheet. And if we want to walk through the balance sheet really quickly, on the asset side, current assets, these are the assets that are readily convertible into cash within 12 months. So that's why it's called current. Current assets will include cash, and sometimes you'll see it either cash or cash and cash equivalents. Cash equivalents will be those other types of cash accounts that can be converted into cash in the short term, such as money market account or CDs that are short-term CDs that can be converted to cash within 12 months. And after cash, you'll see accounts receivable. Accounts receivable is also considered a current asset because it's expected to be turned into cash within, ideally in less than 90 days. And then inventory is also considered current because inventory is also expected to be turned into cash within 12 months or less. And here we have total current assets of $150,000. Next, after that, we have other assets, and in this example, we have property, plant, and equipment, and these are more investment from the company in its future. And so this is things like the office or the furniture or the computers that the company is using. And usually it's presented on a net basis from accumulated depreciation. So in this case here, we have property, plant, and equipment for $300,000. When you add up 150 and 300, you have 450 total assets. Now we jump over to the liability side. We have current liabilities, and current liabilities would be those that are expected to be paid within 12 months as well. So accounts payable, $50,000. Usually accounts payable, when you have invoices from a vendor, it's expected to be paid less than 90 days usually, sometimes 30 days, 60 days, or 90 days. So those are current liabilities. Accrued expenses, these are the expenses that you haven't received an invoice for from the vendor yet or haven't paid yet, but you have used the service and expect to receive an invoice in the future, so you accrue for it on the balance sheet and you book the P&L for that amount. So it's $20,000 accrued expenses. Deferred revenue, you may be wondering why is revenue sitting on the liability side, but deferred revenue, as the name implies, deferred, that's a revenue that you expect to realize as revenue in the future. And so the reason why it's a liability, so you receive, an example of that is that you receive a payment from a customer for a future service or product, but they give you a prepayment. So a prepayment is recorded as a liability. When you receive the cash, it's debit to the cash account to increase it, and credit to the liability, which is deferred revenue. And that's expected to be a current liability as well. And then the next section over is long-term debt. 200,000, and usually long-term debt, the most common way of having the long-term debt is a loan from the bank, and usually that would have a maturity date, and so usually this is more than 1 year. That's why it's long-term versus this is current. So long-term 200K, and then when you subtract then 350, which is a liability, from the assets, you arrive at the shareholders' equity of 100,000, and so the balancing here is that 350 plus 100,000 equity is 450, which balances with the asset side here as well. Now, keeping all that in mind and the balance sheet structure, we can jump into the three financial ratios that we are going to use to measure the company's liquidity, or its ability to meet, to use its liquid assets to meet its current obligations. And the first one is the quick ratio. And the quick ratio, the formula for that is current assets minus inventory divided by current liabilities. So let's take a look at that. So we're saying this is current assets minus inventory divided by current liabilities. So current assets is 150,000 minus inventory of 30,000, which would be $120,000 here. And the reason why we're subtracting out inventory is because this is called quick. So as the name implies, quick ratio is a ratio that implies that a cash or an asset is quickly convertible into cash, and so that you can meet your current liabilities obligation. And so 120,000, which is here current assets minus inventory, divided by 150,000 in current liabilities is 0.8, which is less than 1. And so the reason why we subtract out inventory here is because inventory is not quick. So like you're not expected to be able to just flip inventory into cash. You are supposed to receive a sales order or purchase orders from customers before you can go ahead and convert your inventory into cash. And so in this case here, the way to interpret or to explain to management or to investors what this 0.8 means is that this number is ideally should be a much higher number than that. The higher that number is, so ideally that would be like 3 or 4. That implies that the company has excess in its current assets or quick assets to meet its current obligations. And so the 0.8 here in this example is not a very good quick ratio. Ideally that number should be higher, and this is an indication of just the company not doing so well. And the second ratio that we're using here is the current ratio. The current ratio is very similar to the quick ratio, except that it takes into account inventory. So remember here how we subtracted out inventory to arrive at this quick ratio. Here we're going to keep it in, and so we're just taking current assets divided by current liabilities, In this case, current assets is 150,000 right here, and divided by current liabilities 150,000, and that's a ratio of 1. So this indicates here that the company has current assets to meet its current liabilities. Again, you want that number to be a lot higher than 1. You want it to be 2, 3, 4, and that will indicate that the company has excess current assets to meet its current obligations here as well. And the third metric or financial ratio that we're using is days sales outstanding, or DSO. And days sales outstanding refers to the ability or how long the company takes to convert its sales into cash. And so you want that number, and this is expressed in days. So you want this number to be as low as possible, ideally less than 45 days. And the way to calculate that number is to take accounts receivable balance, AR balance, which is here $20,000, divide that by credit sales. And credit sales, obviously we're only concerned with credit sales because cash sales are collected on the spot. And so credit sales is when you issue an invoice to a customer and collect in the future. And so credit sales here is $10,000 multiplied by the number of days in the period. So $20,000 AR divided by $10,000 in credit sales times 30 days happens to be a month, so 30 days in the period, and that will equal 60 days, which means that this company here takes 60 days to convert its sales into cash. And you want that number to be closer to maybe 30 days or 45 days. 45 days is an industry average, and you want to be within that range. Any number above 45 indicates that you're either slow to collect your cash, so you have a collection problem, or maybe you are not invoicing your customers fast enough. You have a problem with receiving payment. Maybe you're not making it clear to customers on how to pay you. Or it could be that the contracts that you're negotiating with your customers don't have favorable terms. So usually you should try to make the contract with the customer. You should make the payment term 30 days or at the most 45 days, and try to steer clear from 60 days or 90 days. These are too long. You want to keep it under 60 days and around maybe 45 days. And so these are the three most commonly used liquidity ratios used by financial analysts and stock investors. If you like this video and learned something new from it, please go ahead and like this video. And also, if you haven't subscribed to the channel, go ahead and subscribe so that you don't miss out on the videos that I'm putting out weekly. And I'll see you in the next video. Hey guys, welcome to another video. Today we're discussing solvency ratios, and these are balance sheet metrics that measure the company's ability to meet its long-term obligations. If you've seen my previous video on liquidity ratios, the difference between liquidity and solvency is that liquidity generally refers to short-term, so that's the ability of the company to meet its short-term obligations, versus solvency. Here today we're discussing these three metrics or KPIs that measure the company's ability to meet its long-term obligations. And the reason why this is important for you to know is that if you're preparing for a job interview as a financial analyst or any kind of finance position, or if you're an investor in the stock market, it's good to know these ratios so that you are measuring the companies that you're investing in, as well as if you're reading an article, you're able to know what you're reading. So this is the topic of this video today. And if you're new here, welcome. Thanks for stopping by. My name is Bill Hanna, and I'm the financial controller. I've been in finance for the last 15 years, and I've been an auditor, a financial analyst, a controller, both at public companies and private companies as well. And this channel is all about giving you the summary or the juice of my experience. So if you're in finance or into stock investing in general, go ahead and subscribe to this channel so that you don't miss out on any of the videos that I put out weekly. And without further ado, let's jump into today's video. So the way I want to structure this video is first give a quick overview of the balance sheet like we did in the previous video. So we'll walk through the balance sheet really quickly and gain a quick understanding of the structure of it, and then use that to jump into the three solvency ratios that we are covering today, which is debt to equity ratio, interest coverage ratio, and solvency ratio. And for each of these financial metrics, we'll go through the formula, the calculation, or where we got the numbers from the financial statements, and then we interpret the results. And this probably is the most important part, is like how to interpret the result. For example, if you get a debt to equity ratio of 3.5, what does that mean? Is that good or bad? Is it better to be higher or lower? This kind of thing. I think this is the most important part. So first, let's give a quick overview of the balance sheet. So looking at the balance sheet, and obviously as the name implies, a balance. So the balance here is that we are balancing between the assets. So on one side we have assets, And then on the other side, we have liabilities and shareholders' equity. And the idea is that total assets, which is in this case 450,000, will always equal the other side, which is liabilities plus shareholders' equity, which is also 450,000. And that's basically the main accounting equation, which is, let's write it out here, assets equals liabilities plus equity. And this is what we just said here. Assets equals liabilities plus shareholders' equity. Basically, if you flip this formula and bring the equity on this side, this basic math, you say equity equals assets minus liabilities, which is saying basically that your equity in the company is taking the assets and paying off all the liabilities, which is the same concept if you own a home. So if you own a home, basically what's your equity in the home? It's taking the value of the home and subtracting out the loan value or what you owe in the home. That's your equity. Same thing here in the company. In a company also your equity equals assets minus liabilities. So that's the main accounting equation, and we can now use that to jump into the three financial ratios. The first solvency ratio we're looking at today is debt to equity ratio, which measures the reliance of the company on debt to raise capital versus equity. Because the two ways for the company to raise capital will be one, either debt, or two, equity or selling stock. So basically, the higher this number or ratio here, which is in this case 3.5, it indicates that the company relies heavily on raising capital through debt. So basically, the formula for that is total liabilities divided by equity. Total liabilities here from the balance sheet is 350,000 divided by equity, which is right here, shareholders' equity 100,000. So that gives us 3.5. And basically, the higher that number, as we said, it indicates the company relies more on debt than equity to raise capital. It's not all that bad usually if it's the higher the number, it indicates that the higher the debt, but sometimes you want to take advantage of lower interest rate. So it doesn't necessarily mean bad. You have to take it with the context of what's going on within the company. If they're taking advantage of low interest rates, for example, so they rely more on debt than equity. It all depends on the cost of capital. Is it cheaper to pay interest and raise debt, or is it cheaper to issue stock and get the capital that way? So that's the debt to equity ratio in this case is 3.5. The next solvency ratio we're looking at is interest coverage ratio, which measures how many times the company can cover its interest expense from its earnings. So the formula here is EBIT, or earning before interest and tax. That's the acronym EBIT, divided by interest. And basically, when we look at it in this case here, EBIT for this company is 460,000 divided by the interest expense in the same period, which is 50,000, which gives us a ratio of 9.2, which indicates that the company has 9 times the amount of interest in earnings. So that's usually the higher the better. You want that number to be high, so that indicates that the company can cover its interest expense 9 times over, which means that they have interest, they have excess funds to cover beyond the interest. So basically here it's 9.2, and that's the interest coverage ratio. The third and final ratio that we're covering today for solvency is referred to as the solvency ratio, and that basically measures the company's ability to meet its long-term obligation using its free cash flow. And you'll see that in the formula, because the formula for it goes net income plus depreciation, which basically refers to cash flow. If you take net income and add back depreciation, since depreciation is a non-cash expense, there's no cash going out when you have a depreciation expense. So you add that back, which basically is free cash flow divided by total liabilities, which in this case, net income plus depreciation is 420,000 divided by total liabilities from the balance sheet here, 350,000. You get a multiple of 1.2. And obviously, you want that number to be as high as possible. The higher it is, it indicates that the company is more solvent. It has free cash flow to cover the long-term obligations multiple times. In this case, it's 1.2. It's not all that bad. And obviously, if it goes below 1, it means that the company doesn't have enough free cash flow to cover its long-term obligations. And that's the third ratio, or the solvency ratio. So this is it for today's video. These are the major solvency ratios, or the financial ratios that measure the company's ability to meet its long-term obligations. If you liked it, go ahead and hit that like button. And if you haven't subscribed already, go ahead and subscribe to the channel. That will help me grow the channel. And if you know someone in your network that will benefit from learning about the balance sheet and the 3 solvency ratios, please go ahead and share it with them. That would help me as well. And I'll see you in the next video. Hey guys, in today's video, we're discussing 4 balance sheet KPIs that are used by financial analysts and investors to measure a company's financial leverage. But let's take a step back and define KPIs and define financial leverage. So KPIs are key performance indicators, and these are ratios that we use as financial analysts to talk about the company's financials in a relative form. So rather than giving a dollar amount to someone, we give him a KPI or a ratio. So for example, if you're asked by an investor or by management to tell them, describe the company's debt position. So you may give them the dollar amount of the debt. So you may say, for example, the company has $2 million in debt, or you can give them a KPI or a key performance indicator, which will be a ratio that will give them more information. For example, if the total debt that the company has is $2 million, so rather than saying that the company has $2 million in debt, you can give them a ratio like debt to equity ratio, which in this case will take $2 million of debt divided by the amount of equity. Say the equity is $1 million, and give them a ratio which will be 2 million divided by 1 million will be 2. So that would be then an indication that the company has twice as much capital raised from debt than from stock issued. And so KPI just has more information than just giving a dollar amount by itself. And in today's video, we're talking about 4 KPIs that would measure a company's financial leverage. So let's first define financial leverage, which is basically the strategy of the company to raise capital. So there are 3 main ways for a company to raise capital. One is through issuing debt, most often in the form of bonds, or issuing new stock to new investor or to existing investors. Or the third way would be to raise capital through its own operations from the free cash flow that the company generates from its own operations. And so those 4 KPIs that we will discuss today will give a new investor an idea on the mix of strategy that the company is using, whether it's from debt or issuing stock or its own operation. So without further ado, let's jump into today's video. And if you're new to the channel, welcome. My name is Bill Hanna. I've been in finance for the last 15 years. I started out with PricewaterhouseCoopers as an auditor, and then I transitioned to a financial analyst role, and then worked my way up to a controller position, which is what I do now. And this channel is all about giving you the summary of my experience over the last decade and a half in finance. So if you're in finance yourself, go ahead and subscribe to that channel, and let's jump into today's topic. Okay, so let's begin by looking at the balance sheet of the example company that we are looking at today. And this company is called Buy It Now, Inc. If we look at the balance sheet just at a basic level, the basic structure of the balance sheet is that total assets will equal total liabilities plus owner's equity. So in this case, the company has 5.5 million in total assets and has 5.5 million in total liabilities and equity. And all of the KPIs that we will be looking at today are basically trying to measure one thing and one thing only, which is, if you look here at the total assets line, $5.5 million in assets. All of these KPIs, what they're doing is trying to understand the leverage of the company, how the company is financing this $5.5 million in total assets. Is it through debt? So basically, if you can look down here at the liabilities line, the company has $3.9 million in liabilities, or through equity. So the company has $1.6 million in equity. So these KPIs would be pretty much looking and trying to measure and give a quick to understand ratio of where the company stands in terms of the mix of strategy in terms of raising capital. So we'll begin by the first ratio here, or the KPI that we're looking at today, which is debt to equity ratio. And debt to equity ratio, as the name implies, is the relative proportion of shareholders' equity and debt used to finance the company's assets. So basically, it's looking at the amount of debt the company has and comparing it to the amount of equity, and giving us a ratio that's easy to understand and digest. So basically, if we follow the formula for this KPI, it will be liabilities, total liabilities divided by total equity. So in this example here, total liability is $3.9 million. If you divide that by total equity, 1.6 million, you get a ratio of 2.4, which is basically a ratio that tells us that the company uses 2.4 times, that the company raises capital 2.4 times as much from debt as it does from equity. So this is not neither good or bad. Usually for manufacturing companies, that ratio hovers around 2, and this ratio here being 2.4 isn't necessarily bad because in some cases the company is wanting to take advantage of low interest rates, for example, so it will rely more on debt to raise capital. Make sure to download our balance sheet metrics cheat sheet. It's 100% free and an amazing resource, especially if you're a financial professional, finance student, or into stock investing. I'll leave a link in the description, so go ahead and check it out. And again, it's 100% free. Now, if we move on to the next KPI, which is debt to capital ratio. And debt to capital ratio is a little bit similar to debt to equity ratio, except it tries to measure the amount of debt that the company has relative to the total capital deployed. So let's understand it more. When we look at the formula, you'll get it more. So if we look at the formula for debt to capital ratio, basically the formula goes long-term debt divided by long-term debt plus equity, which is basically what we are trying to compare by looking at the formula is the amount of debt compared to the total capital deployed in the company. So the long-term debt in this case is, if you look in the balance sheet, is $2 million, and if you take that and divide it by the total capital deployed, which will be the same $2 million from long-term debt plus equity, which will tell us then $2 million divided by 3.6 million, or a ratio of 0.6. You can read it as 0.6 or 60%, which is saying here that 60% of total capital raise is coming from debt. So basically this gives you an idea of how much of the total capital deployed in the company that comes from debt, and is 60%. This seems to be fairly reasonable. Again, it's neither here in this case good or bad. You have to take it in context. If the company is trying to take advantage of some favorable interest rates, it might raise more capital, or if the interest rates are high, it might be cheaper to issue stock. So this here is 60% for the debt to capital ratio. Okay, so far we've covered two KPIs. The first one is debt to equity ratio, and the second is debt to capital ratio. And now the third KPI is going to be debt to assets ratio, which basically is going to give you an indication of how much of the company's assets are financed through debt. So the formula for it would go, if you look at the balance sheet here, the formula is total debt divided by total assets. That's the formula for the debt to asset ratio. So basically we're taking the $2 million from total debt, which is the long-term debt, and dividing it by $5.5 million in total assets, and get a ratio of 0.4 or 40%. You can read it either 0.4 or 40%, which is basically saying that 40% of the company's assets are financed through debt. So now that we've covered three of the KPIs that we want to cover today, we're on to the last KPI, which is the financial leverage ratio, which is very similar to the last KPI that we covered, which was the debt to asset ratio. But this one looks at it a little bit differently in terms of multiple. So let's look at the formula and we understand it a little bit more. So if you look at the financial leverage ratio, the formula goes total assets divided by total equity, which basically, if you look at the balance sheet here, the amount of total assets is 5.5 million and the amount of total equity is 1.6 million. And you can tell what this KPI is trying to do by dividing assets divided by equity, is trying to say how much of the assets are supported by equity in the company. So basically here the multiple is the result of the ratio is 3.4 when you divide it. So 3.4, you want that KPI to be as close as possible to 1, because basically when it's close to 1, it's saying that a lot of the assets of the company is supported by equity or ownership in the company. But again, if the company is leveraging more debt because the interest rate is low in the market, so basically that could be a high number. So the answer is that it depends. Ideally you'll be close to 1 as much as possible, but in this case we don't know if the company is trying to take advantage of low interest rates, and so it's relying more on debt than equity to finance its assets. I'm going to go ahead and leave a link in the description of this video for you to download a summary of all of these KPIs along with the calculation, the formula, and the explanation of each one, so that you can go ahead and download that and read it later. And if you like the video and learned something new from it, go ahead and smash that like button. And if you haven't subscribed to the channel, go ahead and subscribe now, and I'll see you in the next video.